Hi there, and welcome back to the Metaverse Stock Exchange. In this video, we're going to be talking about something very critical that's happening in the financial sector right now. And should you be concerned? And is this the potential start of a new financial crisis? So, in order to answer those questions, first we need to see what is happening right now. And everything is starting with Silicon Valley Financial. This is the 15th largest, or at least it was the 15th largest bank in the United States, and it focused very much on funding venture startups in Silicon Valley. It was a very good, revered bank in that sector. Now, what is happening? So, if you will see a 5-day chart, this stock started at $280 a share just on Monday. But right now, yesterday it closed at $106 a share. But even more importantly, in the pre market right now, it's down another 40%. So it's pretty much plummeting to probably either bankruptcy or to a very, very low price. And this has caused the entire financial sector to go down as well. So I have multiple tickers here for you to see that even though it is right now a one bank specific issue, the entire financial sector is dropping. So we have Bank of America, we have JP Morgan, we have the KBW indexes, both the regional and the wider one, and all of these either stocks or indexes are down 7, 8, even 10% on the week, which is very strange. Like for a bank of like Bank of America to be down close to 10% in just 5 days, that really doesn't happen that regularly. And this is because of fear of contagion, something that happened in the 2008 crisis. So before going into what is contagion and is it happening right now, let's see what happened with Silicon Valley Bank. And we have Reuters here explaining. Silicon Valley Bank launched a 1.75 billion stock sale on Wednesday, and this is what caused the stock to kind of immediately plunge here. You can see this kind of giant dip downwards, even though the stock was kind of falling in the days prior to that, to shore up its balance sheet. It said in an investor prospectus it needs the proceeds to plug a $1.88 billion loss. So this is very important. So they had a $1.8 billion loss because they had to sell a $21 billion loss-making bond portfolio, mostly consisting of US Treasuries, which yielded 1.79%. And right now, the current yield on the bonds is 3.9%. So if you don't know what bonds are, this is fixed rate financial instruments that you buy and then you hold them and you get a return. So how can they lose money on a fixed rate instrument? In order to understand this, because that's pretty much the main problem with this bank right now and what can cause other banks to have similar problems, let's go and check how bonds work. So bonds have a yield, right? Whether it is 1.8 or 3.9, whatever, but whatever the yield is, but how they get that yield is there is a current price. So let's say in the first example here, we have a bond selling right now for $98 a share, a bond, sorry. And then at maturity, it will pay you $100. And maturity could be in a year, 2, 3, 5, 10 years, right? Doesn't matter. And the yield that you're going to get is pretty much the difference between what you're paying right now, which is the $98, and then what you're going to get at the end, $100. And that's approximately 2%, something above 2%, but let's round it up. It's you're going to get a yield of 2%. But what is happening right now? Because the Federal Reserve is jacking up interest rates and kind of to slow down the economy, then all yields, including the yields on the bonds, obviously are rising. But keep in mind that the bond didn't change. So at maturity, it still will pay out $100. So for you to get a higher yield on the same instrument, then the price has to go down. So right now, let's say if we have a 5% yield, even though at the very end you're gonna get the $100, that bond right now is trading for $95 a share. And I have a kind of graphic example here. So what happened with Silicon Valley Bank? They bought their bonds, let's say at $98 a share. And the plan was buy them, hold them to maturity, and get the 2% yield, right? But Meanwhile, the bonds are trading. They go up or they go down because the yields obviously are changing. And because yields are rising, the price is falling. So meanwhile, right here, we call it in economics upside down, and I even have it written here in upside down. The bond price changed, and it went down to $95 for that bond. That's the current price. And if you're selling at that price, then because you bought it at 98, you have a $3 loss for that bond that you're selling. And that's what happened here. Because they had to sell these $21 billion worth of bonds, they had around 10%, 1.8 billion. So that's around 8%, 9% of losses they had to take. So in their case, because it was 1.78, they probably bought them. Let's say if they got $100 at the very end, they bought them even higher than this, and that's the difference that they're losing the money. So normally you wouldn't do this, right? Why would you sell it at 95 when you know that you're gonna get $100? So because keep in mind, whatever the price right now, you're still getting the $100 at the end of the bond, right, at the maturity date. But they had to do this. They were facing a lot of deposit withdrawals, and they needed the money. And that's why this is very important for all kinds of investing. If you need the money and you have to sell at a loss, then you're taking those losses right away, even though you can take profits in the future. So that's what happened here. So that's Silicon Valley, and obviously it's a one bank problem. But why are all banks now falling? Because here, very importantly, if we kind of look through the kind of analyze the text, it said it sold off $21 billion of bonds. That's very important for you to understand why there might be contagion, because $21 billion in the bond, kind of in the treasury market, which is worth tens of trillions of dollars, is not very important. But if other banks then start selling bonds because they also have some liquidity problems or deposit withdrawals, like there's a run on the banks, other people are like, hey, I don't know, that Silicon Valley bank is kind of going down. Maybe I'm going to take my money out of whatever that is, Bank of America or JP Morgan, or much worse, the regional banks that are kind of far more exposed. Then they would have to kind of be forced to sell more bonds. But right now, these $20 billion, there's somebody to buy them. And that's the most important part. Financial crisis start when there is nobody to buy these bonds. And that happened both in 2008 and in 2020 with the coronavirus happened, right? And in 2020, the Federal Reserve, pretty much, this is an announcement in March of 2020, when pretty much all financial markets and the stock market kind of reversed, when they announced Federal Reserve to backstop the US money market industry and support other central banks. This was the key moment when the Fed Chair Powell, I listened to him live when he came out and said, we're going to purchase all bonds and all mortgage-backed securities. And even though they set a goal for $500 billion a day, which was crazy, even when asked, hey, is that a limit? He said, no, there's no limit. We just put it because we don't think that we will need to buy $500 billion a day. But whatever it is, we're going to buy it. And in order to see that, this is here a representation of the Fed's balance sheet. So this is the 2008 financial crisis when they started doing this bond purchasing, right? So they were shoring up the economy because there was nobody else to buy these bonds, right? Because as I said, $20 billion, not a problem. But if it is hundreds of billions of dollars or even trillions of dollars that somebody needs to purchase, then financial markets collapse and there's no buyers for them. And that's what happened both in 2008 and in 2020, even though in 2020 it was for all instruments. In 2008 mostly it was for mortgage-backed securities, but whatever the case, it was financial instruments. So the Fed did what it did. You can see this initial spike here. And even for the last 10 years, they have continuously had a program of quantitative easing, meaning they were purchasing bonds to stimulate the economy. Here you can obviously see this giant, enormous spike in 2020 and even in the upcoming period. Now, what is very important, this downtick here. So last year, when they started tightening the economy for the first time ever, we had quantitative tightening, meaning they were no longer purchasing new bonds and they were letting the old ones just kind of run off right? So they're not selling, but they're letting, if a bond is maturing, that's it. They're no longer purchasing another one to keep their balance sheet, which is a process of quantitative tightening and kind of squeezing the economy to slow down because we have a massive inflation right now. Inflation is a huge problem. That's why we have this, plus we have the interest rates going higher. So why am I saying this? Because we are in a pretty bad place if there is some kind of systemic problem. Now, hopefully, Silicon Valley Bank will be the only bank that has this problem. But if we see other banks, and we do have examples where Silvergate, another bank, also had some problems, even though Silvergate is kind of crypto related. But we had this a couple of days ago where crypto-focused bank Silvergate is shutting operations and liquidating after market meltdown. We have other banks that have that do have some problems. And why do we have this lose-lose scenario? Because God forbid the Fed needs to kind of intervene in the market. It is a lose-lose scenario because if they don't do anything, then we can see a financial crisis where kind of banks have problems not selling their bond portfolios or taking huge losses, and then that can cause an economic crisis. Or if they do intervene like they did in 2008 and 2020, then that means a lot of more money printing or lowering of rates, which can stoke even further inflation. And even though we still haven't even beaten it, we can just fire it up again. So that's kind of this crisis explained. It will be very interesting in the next upcoming days, and just for you to think about it, we could be seeing, hopefully not, this is how financial crises start, with these rapid sales where banks are forced to liquidate and sell at a loss. Hopefully it doesn't spread, but the main thing that I wanted you to know is that in the last two crises, we had the Fed, and that was the backstop. But now, I don't know if we will have it. And even if we do, then that will cause more inflation and more of those problems. So that's why it is a lose-lose scenario. Hopefully you enjoyed the video, and I'll see you in the next one, and I will keep you up to date on what is happening. Thank you.